Hello and good morning or good afternoon, everyone. So thank you for joining me today. And today I'll be discussing some trends in ESG integration and things we see that are going to shape the market going forward. So before I dig into the agenda for today, just a quick introduction. So my name is Shaheen, Contractor. I cover ESG for Bloomberg Intelligence, which is Bloomberg's research team. So just for some background, Bloomberg, just as we collect financial data, we also collect ESG data. So we're looking at about 500 different ESG metrics across about 11,000 different companies. And my job is to take all that data that Bloomberg has and provide analysis into it. So write about industry trends, industry drivers, basically how investors use that data. So we cover a number of topics, things around climate change, green bonds, social factors, how governance impacts companies, and basically all the fun stuff. And I'm going to be discussing a lot of that today. So today we're going to start by looking at the growth we've seen in sustainable investing and some of the drivers behind it. We're then going to talk about ESG integration and how this has evolved to a concept called materiality, which is becoming increasingly important when analyzing the financial implications of ESG. Materiality is just the idea that different ESG metrics impact different sectors, and there's no one-size-fits-all model that we can apply. And then the last part, probably the most exciting, so don't fall asleep. This is around ESG performance, why ESG behaves the way it does, and some of the trends we see that are hitting the market, especially due to COVID and the recent financial markets turmoil that we've seen. So let's start by looking at the growth that we've seen in sustainable investing. Now, the chart that you see on the screen looks at assets under management for ESG ETFs, which we've seen grow almost exponentially since 2015. So just if you look at this chart, we see that as of June 2020, assets have reached about 116 billion, almost 3 times that of 2017. This just points to the actual money that is flowing in and why ESG matters in the public markets, why people should pay attention. Now, what constitutes this chart or what's defined as sustainable investing varies. But let me take a step back and tell you sort of how I classify it. So to me, sustainable investing is 3 pillars. So the first is more exclusionary screening. So investors who remove companies based on screens such as alcohol, tobacco, or things that align with their values. So this to me, as in the title, is values-based ETFs. The second is looking more at ESG integration. So actively looking at ESG metrics like carbon emissions or safety factors, governance factors, to either mitigate risk or create opportunities when analyzing companies. And the third is a more thematic angle. So looking at either one of either the E, the S, or the G, things like climate change or gender, or a focus on corporate governance. So a more thematic angle, either digging into one of the pillars of ESG. Now, let's take a look at what are the drivers behind this growth. So if we look at what's been driving this market over the last probably 10 years or so, it's largely pension funds, particularly in Europe. So large asset owners with these long-term time horizons have always been the traditional drivers of ESG. In fact, if you look at 2019 and we look at the largest ETFs created, both the largest ETFs in the US that were created were both ESG funds, and both were seeded by a large Finnish pension fund. So this just goes to the fact that these investors are going to continue to drive this market forward. And that's probably why within this chart, if you divide up assets by region, you'll see that Europe just accounts for a majority of the assets. It's if you look at the 2020 bar chart, Europe is about 54% of assets, and the US is probably close in at about a little over 40%. The interesting point, though, and I'll note this in my next slide, is that US is closing the gap. Europe sort of started off at a high base, but a lot of the growth is coming from the US markets and also the emerging markets, APAC, particularly Japan. Again, Japan's pension fund, the government pension, one of the largest asset owners in the world, has a large focus on ESG, which is driving this forward within that market. However, one interesting point is that while we have growth, we also have increasing amounts of fee pressure and competition that is confronting this space. So one interesting point to note is that this space is getting crowded by large asset managers with relatively low cost structures, at least ESG ETFs. And this is making it hard for smaller asset managers with perhaps more expensive ratios survive. So along with this growth, we've also seen an increase just in the liquidation of funds. This, in the first half of this year itself, liquidations peaked. We saw about 11 liquidations. And just to give you a sense of the consolidation within the industry, two asset managers, so BlackRock and UBS, they account for over 50% of assets. So that's a fairly consolidated market where it's going to become harder and harder for smaller asset managers to play in unless their funds see adequate demand and expense ratios are low. So we're going to see these forces of growth and liquidation play out over the next few years. Now, coming to this chart, which looks at the flows that this category has seen, again, a depiction of just the growth and the money flowing in. One of the large reasons for the increase in assets we saw in the previous slide is an increase in flows to ESG strategies. So if we look at this chart, we'd see that flows to ESG within the first half of this year reached about 30 billion. Now, this is particularly notable because 30 billion was what we saw in all of 2019, which means that if the current pace is maintained and we saw the same amount in just half the year, flows could in fact double this year versus 2019. And again, we have to remember that this is even amidst the financial crisis we saw where markets saw a drawdown. And within that drawdown, a lot of ETF strategies saw significant outflows of money. ESG was probably contrary to that, and that's why we call flows into ESG ETFs sticky. These did not see the outflows in funds that we saw for traditional ETFs. And hence we think ESG is not very market reactive, it's sticky. Another good indication is that when markets went into one of the worst drawdowns, only 8% of US ESG ETFs saw outflows versus about 22% of all US ETFs. So again, this is not very market reactive, which means that even in a downturn, you have this consistent amount of money flowing in. Probably because investors don't view ESG as some kind of trading strategy. It's more a longer term investment where regardless of the market, money is going to be allocated. One interesting point though is that even though we're seeing this tremendous growth, a lot of the money flowing is due to large asset managers with low cost structures moving their own ESG ETFs into their own asset allocation strategies. Now, one example is BlackRock, which has been doing this for, I believe, ESGU is the ticker, and an asset manager moving their own ESG fund into their own model portfolios. is a little bit of a gray area. It doesn't represent organic market demand. So while we see this tremendous growth, it is important to note that a large chunk is due to this flows. So growth in assets, growth in flows, but at the same time, increasing fee pressures, competition, and probably a little bit of a gray area on organic market demand being represented entirely by this. So let's take a little bit of a step back and look at how sustainable investing has evolved over the last probably 10 years. So to the left of my screen, you could see the Norway Council on Ethics exclusion list. And this is a very typical strategy, probably how sustainable investing started 10 years ago. 10 years ago, it was all about exclusions, or as I mentioned, sort of the first pillar of sustainable investing, investors looking to exclude companies based on things like alcohol, tobacco, or just based on their values. And the Norway Council on Ethics, which serves the Norges banks at the Norway pension, is a good example of this. And we maintain an index of all of Norges bank's exclusion lists within our terminal. And every time a company is added, we just add it to the index. So just because of the size of Norges Bank, I believe third largest asset owner in the world, a number of investors use this list as a starting point, as a sort of benchmark to analyze companies that they should be excluding. Now, while this field, probably 10 years back, focused on exclusions, what we're seeing it move to is more a focus on ESG integration. So again, as I mentioned, actively looking at ESG metrics like carbon emissions, safety, or gender to either mitigate risks or create opportunities. And these two strategies still go hand in hand within funds. They both are normally involved, but we're seeing the growth and the discussions come from ESG integration. So to the right of my screen, I have an example of some of the data that Bloomberg collects. And again, just to go back to sort of the introductory background, at Bloomberg, just as we collect financial metrics, we also collect ESG data. So looking at about 500 different ESG metrics, probably a summary or a smaller subset of what you see to the right in the image. And these ESG metrics across about 11,000 different companies. So just the way it works, if you load any equity ticker on the Bloomberg terminal, I have AEP, which is an American utility on the screen, and you run the function ESG Go, you're going to see the image to the right, which is basically just a quick snapshot of how the company performs in terms of key ESG metrics versus itself. So you'll see one section which says versus history, and then you have versus peers. And so this is the data that Bloomberg collects from company sustainability reports, annual reports, or any publicly disclosed sources of information. So things like GHG emissions just normalized by revenue, or things around governance like independent directors. So looking at how that compares historically and versus peers. So along with this data that we collect, which you probably see towards the bottom of the screen, towards the top right of that image, we also have third-party ESG scores. So things like Robeco SAM and Sustainalytics, which are just broad-ranging ESG scores. Things like ISS, which is a governance score, and then CDP, which is a climate change score. So these scores, the way the market views them is sort of a fill in the gap where there is little underlying data or no underlying data. These scores serve to provide some kind of direction on the performance of a company. And just again, going back to the evolution, we've really seen discussions, asset managers, companies, and investors shift this focus from a conversation that was based on exclusions but is now based on ESG integration. And just to provide an example of how we can integrate ESG scores or analyze them within the Bloomberg environment, and this probably applies to just sustainable investing in general, I have created an equity screen which looks at an index and then screens for all those companies that are within the top quintile of all the third-party scores. So I've just taken the S&P 1200 and you see just the top performers. And I've screened for top performing Robeco Sam, Sustainalytics, and ISS scores. And again, going back to the evolution, we've gone from exclusions to ESG scoring, but where this conversation is moving now is more towards the underlying data. So similar to the way in which we can screen for scores, we can also screen for individual ESG metrics. So say, for example, an investor wanted to understand the carbon intensity of the portfolio and what is driving this. So you could create the same screen, bring in metrics like GHG emissions by sales, and start to look at probably the highest, and then think about reweighting companies based on this. So again, that conversation is really shifting away from scores a little bit, more towards the underlying data or what's driving that score. So underlying data around how the company performs on different environmental factors, different social factors, things like emissions, safety, or how the company is managing climate change. And we're seeing indications of this if you look at our ESG ETF Flow Charter. So we're seeing this increasing breadth of strategies when we look at the funds that are coming to market. What I did for this flow tracker is I went through 400 ETFs and I classified them based on their strategy. So just because it looks at inflows and outflows into different ESG or sustainable investing strategies, things like gender, clean energy, or diversity and inclusion, it paints a fairly good picture of just investor demand, money supply, where money is going in and where it's coming out of. And what we see here, for example, just the line item on SDG and impact, we see this sudden growth in flows in 2018, all due to new fund creation as the SDG framework finalized. And this is just an example to show that there is a need for more complex and more intricate data sets, ones that are more niche, more thematic, perhaps focused on diversity and inclusion. And this is where investors are looking to go beyond scores, because these niche and complex themes require the underlying data that an integrated approach does not get at. So again, we're seeing this shift in flows in conversations more towards the ESG data, and this supports the increasing breadth in strategies we've seen play out, especially over the last few years. As I mentioned, on Bloomberg, and probably if you look at the number of ESG data points for a lot of data providers, or the things that you could look at, it well crosses a couple of hundred. So perhaps the most frequent question I get when people start looking at ESG metrics and trying to analyze companies is just, Shaheen, you have 500 different metrics. Where do you even start? And that's where the concept of materiality comes in. The understanding that different ESG metrics impact different sectors and there's no one size fits all. Just as an example, maybe for cement, because cement is a very highly carbon intensive sector, I would look at things around climate change, carbon emissions, and energy use. But I wouldn't perhaps look at the same metrics for a technology company where supply chain issues are probably more material, things around human rights and supply chain. So again, going back to the fact that for each sector, there are different ESG metrics that apply, and looking at a one-size-fits-all is perhaps not the right approach. So what I'm going to do is walk you through a quick case study, something that we did for iron and steel peers to analyze materiality, which will probably give you an understanding into how we view ESG for a particular sector and how we try to analyze company from a leaders and a laggard standpoint. So what you see in this chart is, again, a quick example, our materiality analysis of iron and steel companies. And you'll see the metrics we chose to the topmost row. So these things run energy per product, safety, and also carbon. Again, iron and steel, one of the most carbon intensive sectors that we'll see later. So this, what we call heat map or peer performance chart, gives you a quick snapshot of how companies perform. Red is bad, green is good. And just an example, if we look at ArcelorMittal, their energy per product measured as megawatt hour per crude steel is about average. So this chart probably gives you sort of the good, the bad, the ugly. What is the average performer? Probably, if you want to benchmark best performers, where does that lie within the spectrum of probably the companies that have the largest market cap within the sector? So again, sort of looking at ESG metrics compared to peers, but more from a materiality angle, looking at metrics that we deem to be the most material. And just walking through sort of how we can go beyond the metrics. So how do we try to understand and get at materiality? So in the previous chart, we would have seen that carbon and energy were the first two pillars of our peer performance table. Now, just looking at the top left graph within the slide, when we're looking at carbon intensity per sector, what we see is that iron and steel is probably the second most carbon intensive sector amongst everything out there. You'll see that if you look at intensity, it starts at cement, iron and steel, airlines, utilities, and it just tapers off after that. And this goes again to the question of materiality. Would we look at carbon for technology in the same way as we look at it for iron and steel? Perhaps not. And similarly here, if you just put a theoretic carbon cost on this sector, we'd see that if we look at the median, probably about 20% of an iron and steel company's operating profits are going to be impacted, are going to be the cost that the company pays. And when it comes to technology, it's probably a little over 0%. Again, in reality, these costs are passed on. Within Europe, at least for the emission trading scheme, they have free allocations. But this serves to paint a picture on what would be impacted if regulations are strengthened, and they are being in Europe, and I'll come to that later. So again, just a way to analyze what is material for a company and how we get to that sort of underlying peer performance table. And in the chart to the right, what you see is sort of going beyond the data. While we have data around carbon emissions, one thing that I find particularly useful is looking at the forward-looking trajectory that the company has set. And this is via carbon reduction goals. And what we've done is we've taken these carbon reduction goals that companies report, annualized them, and then overlaid the carbon intensity. And this sort of creates a good divide. It tells you who are the leaders, who are going to continue to be the leaders, and on the flip side, who are the laggards. And just from what we see here, we see companies, again, of course, in Europe, ThyssenKrupp, Wolfspeed, these are the leaders, and they have an annualized reduction when it comes to carbon emissions, which is well over 2%. Whereas if you look at companies like Everaz or even others, we see a much lower ambition. And that's where, when we're looking at an ESG analysis on companies, I like to use or sort of understand three aspects. So the first is ESG metrics, as we saw in the previous slide. Performance of material ESG metrics compared to peers. The second is this forward-looking view of a company. So things around carbon emissions, carbon targets, where the company is heading. And the third, which I don't have in this chart, but I think it plays an important analysis, again, of trying to understand where that company is heading, is looking at board oversight and incentives around ESG. So things around ESG-linked compensation, or how much of an executive's bonus is linked to ESG. These provide more forward-looking analysis into the company and where it's heading, as opposed to ESG metrics, which are in a way backward-looking. So again, ESG metrics versus peers, goals and targets the companies are setting to provide a forward-looking view, and board oversight and incentives around ESG to understand culture, and again, a more forward-looking view of ESG. So I just want to mention sort of an interesting development when it comes to Bloomberg's direction around ESG. And one thing that's new is that we recently entered into the wonderful realm of scoring. So traditionally, Bloomberg has been all about the data, the underlying data that we collect from companies. So sort of the ESG screens you've seen before. The data around emissions, gender, and more so the public data that we collect. We've traditionally never delved into scoring, but this is something that we changed just as about last month when we released board composition scores for about 4,500 companies. And what you see here is the board composition score, which is a pillar within a broader G score that Bloomberg hopes to develop. And the direction being taken for the environmental and social pillars is again going back to our research on materiality. So looking at scores for material ESG metrics versus peers. And we've released scores for about 200 plus oil and gas companies, and we're going to be releasing more on a rolling basis. So just an interesting development that is new and probably will shape a lot of our research going forward as these scores are developed. So now, coming to perhaps the most exciting part, I want to touch upon concepts of ESG performance, especially in light of the recent financial drawdown we've seen in COVID, and also touch upon some points that we think are going to impact the market going forward this year and through next year. So the things I'm going to discuss are, first, that ESG indexes, or ESG as a strategy in large, has seen the sort of relative outperformance during COVID. The second is that as a result of COVID, we've seen this increased focus on the S within ESG. Now, even though we've seen an increase in the S, the E continues to gain momentum, especially in regions like Europe, where we have fiscal stimulus like the EU Green Deal, which is going to continue this momentum. So let's start by digging straight into performance. So what we have here is ESG indexes versus their non-ESG indexes. So sort of a direct comparison to understand what value that ESG provides over their non-ESG benchmarks. And what we see is that ESG indexes across the world, so Europe, USA, emerging markets, outperformed for the second consecutive year, something that we think could continue to sustain a growing asset base. Just as an example, the MSCI Europe ESG Leaders Index outperformed by almost 5% over the year ending June. What's interesting is that we find that these indexes showed particular strength during COVID, providing this sort of buffer during the downturn. In Q1, when all markets entered a drawdown, most of our ESG indexes and ETFs that we analyzed outperformed the market. However, even though ESG outperformed during Q1, during the market drawdown, results have been in a way mixed in the second quarter when markets rebounded off lows. And that is something that we see throughout this year. ESG tends to outperform during a downturn, but it underperforms in a bull market. And this is all relative outperformance or underperformance. So again, this buffer during a downturn, but it fails to keep up in a bull market. And if we look at the reasons why, or perhaps first looking at whether this is an anomaly and this is something we only saw this year, so that's not the case. This is something that we've in fact seen, I would say, over probably the last 7 years or so. And if you look at the image to the left, what you'd see is a chart which is the relative ESG performance. An uptrend indicates an outperformance of ESG. A downtrend indicates a relative underperformance of ESG. So similar to what we saw this year, when it comes to ESG, we see these varying degrees of outperformance during the market downturns of 2015, 2018, and now 2020. But we see an underperformance during the bull cycles. So for example, 2017 was a bull cycle where we saw underperformance. Now, if we try to understand why, a lot of this can be explained by ESG's factor exposures. So ESG as a strategy tends to tilt towards this mix of low volatility and quality stocks. And as a result of this factor exposures, low volatility and quality, they outperform during a downturn, but they fail to keep pace when the market heats up. The point I would mention though is that low volatility and quality, these factors, they tend to outperform over longer term time horizons. And that's where we think ESG has an opportunity to outperform again over longer term time horizons. And hence, looking at this 1 year, 1 quarter sort of view of ESG is not holistic, because this is something that needs to be looked at from a longer term time horizon. So again, low volatility, quality, providing this sort of buffer during downturns, and that's where we see the value add of an ESG strategy. It's risk mitigation. Now, if we look at performance for climate change indexes, one interesting trend we see is that fossil-free indexes and low carbon indexes outperformed throughout the year, gaining strength as oil prices dropped. Now we can see this outperformance in the charts on the screen. One of the more interesting pieces that we saw is this outperformance of fossil-free indexes, even though oil prices increased. So typically what we see is that these indexes move inverse to oil. When oil prices increase, fossil-free underperforms. However, this trend, increasingly enough, stopped in 2018, and fossil-free indexes continue to outperform despite oil prices increasing. And the risk here is just that broader demands for renewable energy, electric vehicles, are at the end of the day going to crimp fossil fuel demand and continue to drive performance within these indexes. If we look at sort of the climate adaptation side of climate change funds, the interesting point we saw this year is that a Cleantech ETF. So the Invesco Cleantech ETF, which is the orange line in the chart, for the first time it jumped ahead of the MSCI ACWI. So for the first time since 2009, and we think that things like the EU Green Deal and fiscal stimuluses could continue to sustain this momentum going forward. However, it's important when we look at performance to try and distinguish between clean energy and clean tech. So clean energy is sort of the gray line you see at the bottom. Clean tech is the orange line that you see sort of following the MSCI ACWI. Clean tech, to me, goes beyond renewable energy. It analyzes things like energy efficiency or green chemistry, and it's probably less volatile because it has more product diversification. And at the same time, it's not as dependent on government policy as renewable energy. And hence, we see this gap. Clean tech has leapt ahead of the market, but clean energy fell in 2008. And even though clean energy has been performing very well over the last year, it's still not gone back to levels that it was probably pre the financial crisis of 2007. Although I will note that as renewables get more cost competitive, we should see the gap narrowing, and that is just driven by cost competitiveness that decreases reliance on government policy. Government policy, of course, makes this very volatile, and we should see this volatility decrease and the gap narrow as renewable increase its cost competitiveness. So another theme that we're seeing play out this year, and probably as a result of COVID, is an increased focus on the S within ESG. So S is always thought of in the past as E's ugly stepsister in a way, but we're seeing this come into focus, and the credit markets are a clear signal of this. We're seeing a growing piece of the pie when it comes to either social sustainability or green bonds in 2020 has been occupied by social bonds and sustainability bonds. Social and sustainability debt issuance, if we look at the chart to the left, it's set to double by the end of this year if the current pace is maintained. Social bond volume has also increased by about 300% just in this year if we compare it to the same period last year. And what we anticipate is for issuance to follow the same trajectory as we've seen in green bonds, which has grown almost exponentially over the last 10 years. And just one important driver in today's market condition is low yields and investor demand, which is going to continue to sustain the momentum in this. And just one notable example that was perhaps the most recent is Alphabet's $5.75 billion sustainability bond as part of a larger deal. And again, this brought in coupons of about 0.5 to 2.1%, very low yields in today's environment. And similar to the chart on the left, where we see social and sustainability bonds increasing, we see the chart to the right, which sort of shows a dip in green bonds in a way in 2020. So again, going back to the point that S is occupying a larger share of interest when it comes to ESG. So even though COVID has brought out a particular focus on S this year, we think that momentum around E will continue, particularly in regions in Europe where you have things like the EU Green Deal, for example, which is a fiscal stimulus that earmarks about 150 billion to environmentally sustainable activities. And you can see further breakdowns in this pie chart. And as we mentioned before, we think this stimulus because it's so focused on things like energy efficiency, building efficiency, electric vehicle sales. This will continue to drive clean technology. So the Cleantech ETF, we saw in a few previous slides that leapt ahead of the MSCI ACWI. We think that momentum will be sustained due to policies like this. And of course, not just the EU Green Deal, but Europe is got an increased focus when it comes to regulations around climate change. The Sustainable Finance Taxonomy, MiFID suitability regulations, benchmark climate change regulations, strengthening of the EU ETS in 2018, the emission trading schemes. These are all signals of how much of a focus climate change is in Europe and how Europe is going to just continue to lead this conversation forward. However, we should note that US and China represent about 40% of global carbon emissions, and as a result, the US election, China's 14th five-year plan are going to be milestones to watch in this year. And just the last point I'd like to mention is to again showcase the increasing focus on E within some areas. So what you see here is our carbon neutral theme basket. So this is an index of companies that have a goal to be carbon neutral that we maintain. And what we're seeing is that our index grew by about 32 companies just in the last quarter, which caused it to double. And this is despite the pandemic. And what this tells you is that despite the pandemic, despite policies, regulations, companies are integrating the environmental aspect, particularly emissions and climate change, within their strategies. So a notable trend by itself, given that we've seen a recent sort of drawdown in the markets, and this has not affected momentum when it comes to transitioning towards a low carbon world for companies. So with that, I'm going to end my presentation. And if I were to just summarize key takeaways, the few things I would mention are sort of when it comes to the question, why should you care about ESG? There is an increasing amount of assets and flows to ESG strategies, the benefit of which we find to be sort of providing a buffer during downturns. ESG as a whole is a risk mitigant in a way, driven by this tilt towards low volatility and quality. When it comes to themes that are impacting the market, we're seeing this increased focus on the S within ESG, even though momentum in E continues to hold, especially in regions like Europe, where this is an increasing focus. And with that, I am going to end my presentation. Thank you, everybody, for taking the time to listen to the presentation, and please feel free to reach out if you have any questions.